The ticker tape does not lie, and it does not have an opinion. It simply is. This fundamental truth is the bedrock upon which fortunes are built and lost in the speculative markets, a truth Jesse Livermore learned not in a classroom, but in the chaotic proving grounds of the bucket shops and the unforgiving arena of Wall Street. Many approach the market seeking a magic formula, a secret key to unlock guaranteed profits. They hunt for tips, for whispers, for anything that might spare them the effort of thinking for themselves. They are looking for a shortcut where none exists. Livermore's path was different. It was a relentless pursuit of a method, an approach grounded in the observable facts of price and volume. He understood that the market is not a random walk. It is a story being told one tick at a time. The great movements, the ones that carry the potential for immense wealth, do not spring from nowhere. They are preceded by clear signals, by periods of preparation, by the unmistakable signs of pressure building beneath the surface. The challenge for the speculator is not to predict the future, but to correctly interpret the present. It is to recognize the moment when the path of least resistance has been established, when the market itself declares its intention to move decisively in one direction. This requires patience, discipline, and an unwavering trust in evidence over hope. For those who wish to delve deeper into the narrative and the timeless lessons of Livermore's journey, an unparalleled resource is available. Max Davidson's detailed chapter-by-chapter analysis of Edwin Lefebvre's classic Reminiscences of a Stock Operator has been crafted specifically for the modern reader. It deciphers the nuances of each trade, each success, and each failure, translating them into actionable wisdom. The link to this unique guide can be found in the description below this video. The very concept of buying a stock as it makes a new high is anathema to the average person. It feels wrong, dangerous, like chasing a train that has already left the station. The amateur seeks bargains, buying what is weak in the hope that it will recover. This is one of the most fundamental and costly errors in the entire game of speculation. Livermore's logic was the polar opposite. He understood that a breakout to a new high was not a sign of risk, but a confirmation of strength. It was the market's own announcement that the forces of demand had overwhelmed supply, and that the line of least resistance was now clearly upward. He was not interested in what a stock should be worth. He was only interested in what the tape said it was doing. This is not a matter of opinion. It is a matter of fact. The stock market is never wrong. Opinions often are. To argue with the tape is to argue with a hurricane. You can be right in your assessment, your logic, your fundamental analysis, and still lose your entire stake because the market has decided to move against you. Therefore, the first rule of engagement is to align yourself with the dominant force. One does not become a successful speculator by fighting the trend. One becomes successful by identifying it, respecting it, and riding it until the evidence suggests that it has reached its conclusion. This is the essence of trading along the line of least resistance. These pivotal points, as he called them, were the key. A stock might trade for weeks or months in a narrow range, seemingly going nowhere. This was a period of accumulation or distribution, a time when smart money was either building a large position or quietly unloading one. The price action during this consolidation was merely noise. The signal was the breakout. When a stock breaks out of its trading range on high volume, it is sending a clear message. The period of indecision is over. A verdict has been reached. The breakout from a well-defined base is the single most reliable indicator that a major move is about to begin. It is the starting gun for the race. This is not a guess. It is a calculated entry based on a clear market signal. The pivotal point provides a speculator with a definable point of risk. If you buy the breakout, your stop loss is placed just below the point of entry. If the breakout is genuine, the stock should not return to its old trading range. If it does, the premise of the trade is wrong, and the position must be closed without hesitation. The average trader fears this moment. They see a stock that has already risen from 50 to 60 and is now breaking out at 61. They think, I've missed it. It's too high. The professional speculator thinks, this is the first confirmation. The move is just beginning. The price is irrelevant. The behavior is everything. He learned early that there is nothing new in Wall Street. There can't be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again. This is because the markets are driven by human nature, and human nature never changes. Fear, hope, greed, and ignorance are constant forces. The patterns they create, therefore, are also constant. The geometry of the market repeats because the emotions of its participants are cyclical. The task is to learn these patterns, to recognize them as they form, and to act decisively when they complete. The breakout is one of the most powerful and timeless of these patterns. It represents a transition from a state of balance to a state of imbalance. Inside the consolidation range, buyers and sellers are in equilibrium. The breakout signifies that one side has won a decisive victory. To trade in the direction of that victory is to trade with the dominant force, not against it. But what constitutes true evidence? Livermore was meticulous about this. A mere poke above a resistance line was not enough. The breakout had to have character. It needed to be decisive, aggressive, and most importantly, it had to be validated by a surge in volume. Volume is the fuel that powers market moves. A breakout on low volume is suspect. It suggests a lack of conviction, a move that can be easily reversed. It is a trap for the unwary. A breakout on a massive increase in trading activity, however, is the footprint of institutional money. It shows that the big players are involved and that the move has genuine sponsorship. Consider a stock trading between $40 and $45 for 2 months. Day after day, the volume is average. Then one morning it opens at $45.50 and trades to $47 on volume that is 5 or 10 times the daily average. This is not random noise. This is evidence. This is the moment the patient speculator has been waiting for. The tape is telling a story of urgency. The large volume indicates that buyers are no longer content to accumulate shares quietly within the range. They now want in at any price. They are willing to pay up to get a position, and this aggressive buying is what ignites the major trend. After the initial breakout, the subsequent price action is just as critical. A valid breakout should not look back. The stock should hold its gains and continue to press higher in the following days. If it immediately retreats back into the old consolidation range, it is a failed breakout. This is a clear signal that the initial move was false, and a professional exits immediately. The time element is crucial. When you are right about a trade, it will usually show you a profit almost immediately. A stock that is breaking out properly should not waffle or hesitate. The move should have velocity. If you enter a position and it does nothing for days or drifts against you, you're likely wrong about the timing, if not the direction. The market is not a place for wishful thinking. You cannot impose your will upon it. Your job is to listen to its message and act accordingly. The message of a failed breakout is simple. You were wrong. Get out. Heeding this message is the difference between a small, manageable loss and a catastrophic one. Think of it as a trial. You place a small initial bet on the breakout. This is your test position. If the market validates your judgment by moving in your favor, you are rewarded. If it invalidates it, you are penalized with a small loss. You do not argue with the verdict. You accept it and move on. The broader market context is the stage upon which these individual dramas play out. Livermore stressed the importance of trading with the general market trend. It is foolish to buy breakouts in individual stocks. No matter how promising they look, if the overall market is in a confirmed downtrend. This is like trying to swim against a powerful tide. You must first determine the direction of the market as a whole. Is it a bull market or a bear market? This is the most important single factor in your speculative success. In a bull market, you should be long. In a bear market, you should be short or in cash. To fight the main current is to court disaster. So the evidence for a breakout is a three-legged stool. First, the price action must be decisive, breaking clear of a well-defined consolidation. Second, the volume must be significantly higher than average, confirming institutional participation. Third, the breakout must be in harmony with the trend of the overall market. When all three align, the probability of success is greatly magnified. This approach demands immense patience. The desire to always have a position, to be constantly in the action, is the speculator's greatest enemy. There are times when the most intelligent thing a person can do is nothing at all. To sit in cash, waiting for the perfect setup to emerge, is not a sign of indecision. It is a mark of professional discipline. Livermore would often go for long periods without a single trade. He was waiting for the market to tip its hand, for a high probability opportunity to present itself. He understood that his capital was his ammunition. He could not afford to waste it on low-quality setups born of impatience or boredom. Don't trade for action was a key tenet. The market is not a casino for your entertainment. It is a battlefield where your capital is at risk. Every trade must have a clear, logical reason behind it, based on the evidence of the tape. If there is no signal, there is no trade. It is that simple. This leads to another of his cardinal rules. Never average down. To buy more of a stock that has gone against you is the ultimate act of hope over evidence. It is doubling down on a mistake. Your initial judgment was proven wrong by the most impartial judge there is, the market itself. To then commit more capital to that flawed judgment is financial suicide. The amateur trader who buys a stock at $50 sees it drop to $45 and thinks it was a bargain at $50, so it's an even better bargain now. He buys more. When it drops to $40, he buys still more, straining his resources and his nerves. He is trying to force the market to prove him right. He is fighting the tape, and the tape always wins. The professional speculator does the opposite. If he buys at $50 and it drops to $48, he is out. The position is closed. The loss is small and contained. He recognizes that his initial entry was flawed. He preserves his capital and his mental clarity, ready for the next opportunity where the evidence is in his favor. But let's be honest. This kind of ironclad discipline is incredibly rare. It's something most traders struggle to maintain, falling time and again into emotional traps. Imagine for a moment if Livermore had a tool that could have done some of this heavy lifting for him. A tool that had already analyzed millions of trades and could simply say, this pattern on this specific stock has historically worked 70% of the time. It would have removed a huge amount of doubt and emotional pressure, wouldn't it? It would transform trading from an art into a science. And as we'll discuss later today, that is no longer a fantasy. Your first loss is always your best loss. This simple phrase contains a universe of trading wisdom. The moment a trade goes against you, it is no longer an asset. It is a liability. It clouds your judgment, consumes your mental energy, and prevents you from seeing new, more promising opportunities. Cutting the loss is an act of liberation. This discipline is not natural. It must be cultivated. Human beings are wired to avoid admitting they are wrong. We are creatures of hope. In speculation, hope is a poison. You must replace it with a cold, detached adherence to your rules. When your stop is hit, you do not reconsider. You do not wait. You act. Ego is the other great enemy. The market has no interest in your intelligence, your background, or your opinion. It will humble the proudest of minds. To succeed, you must subordinate your ego to the reality of the price action. You must be willing to be wrong, to take small losses, and to admit mistakes quickly, The great bull markets of his time were where these principles were proven on a grand scale. He would identify the leading groups, the sectors showing the most strength relative to the overall market. Then he would wait for the individual leaders within those groups to form proper bases and provide him with a pivotal point for entry. He was not trying to buy everything that moved. He was a specialist, focusing only on the strongest stocks and the strongest groups in a market that was itself strong. This layering of probabilities is what gave him his edge. He was always placing his bets on the horse that was already leading the race. Conversely, in bear markets, he would do the opposite. He would identify the weakest groups and look for downside pivotal points, moments when stocks would break down from their trading ranges. His logic was symmetrical. A breakout is a sign of strength. A breakdown is a sign of weakness. The principle is the same. He learned these lessons through repeated failure. His early career was a series of booms and busts. He would make a fortune, then lose it all because he broke one of his own rules. It was the tuition he paid to the School of Wall Street, and the fees were extraordinarily high. One of his most painful lessons came from the cotton market. He had built a massive fortune and was trading with supreme confidence. He then made the fatal error of listening to another man's opinion, a well-respected cotton expert named Percy Thomas. Thomas was bullish, and his convictions swayed Livermore's judgment. Livermore took a large, long position in cotton. The market began to move against him. Instead of cutting his loss as his rules demanded, he held on. He listened to Thomas's reassurances that the move was temporary. He even averaged down, buying more as the price fell, a violation of his most sacred principle. The result was a financial catastrophe. He lost millions and was wiped out once again. The experience was devastating, but the lesson was invaluable. Never again would he allow another person's opinion to override the clear evidence of the tape. The market was the only expert he would ever trust. From that day forward, his thinking was his own. He understood that a speculator must be a lone wolf. You must do your own work, come to your own conclusions, and be solely responsible for the outcome. To blame others or to rely on others is to give away your power. This independence of thought is absolutely essential. The market is a giant mechanism for fooling the majority of people most of the time. Groupthink and consensus are almost always wrong at major turning points. The correct path is often the one that feels lonely and uncomfortable. His early education in the bucket shops was formative. In those environments, he was betting against the house. There was no ticker delay. The quotes were real time. He had to learn to read the tape in its purest form, anticipating the small fluctuations to scalp a profit. He was not trading stocks. He was trading numbers and their momentum. This taught him to focus solely on price and volume. He had no access to balance sheets, news wires, or analyst reports. There was only the tape, and he learned its language intimately. He developed an almost sixth sense for the pressure building behind a move, simply by observing the character of the trading. However, when he moved to the legitimate New York Stock Exchange, he discovered a new problem. In the bucket shop, his trades were just numbers in a ledger. On the NYSE, his large orders actually impacted the price. He could no longer get in and out without causing a ripple. This forced him to evolve his method, to focus on the larger, more significant moves rather than small scalps. This is where the concept of the pivotal point became so critical. He needed a way to enter the market at the precise moment a major move was beginning, to ensure that the market would carry him forward rather than him having to push the market. The breakout from a solid base was the perfect mechanism for this. He realized that the big money was not made in the day-to-day fluctuations, but in riding the great trends. His famous maxim, "It was never my thinking that made the big money for me. It was always my sitting," speaks to this. The difficult part was not identifying the entry. It was having the discipline and courage to sit tight and hold the position through the inevitable minor reactions against the main trend. The average person is too anxious for profit. They will buy a stock correctly on a breakout, see a quick 10% gain and rush to sell, patting themselves on the back for their cleverness. Meanwhile, the stock then goes on to double or triple in price. They win the battle but lose the war. Livermore understood that once you are in a correct position in a major trend, the greatest risk is being shaken out too early. Your job is to stay with the trend until you see clear, unambiguous evidence that the trend is over. You do not sell because you have a nice profit or because you are afraid of giving it back. You sell because the tape tells you it's time to sell. What was that signal? It was often the inverse of the entry signal. Just as a stock would build a base before a major advance, it would often go through a period of distribution at the top. Volume might surge without any further price progress, a sign of churning, or the stock might break a key uptrend line. These were the warnings that the line of least resistance was changing. He was a master of self-analysis. After every major trade, win or lose, he would conduct a post-mortem. Where was I right? Where was I wrong? Did I follow my rules? If not, why not? This constant process of refinement is what separated him from the gambling masses. He was not just trading, he was learning and evolving. He knew that the market itself was his greatest teacher. Every trade was a lesson. The key was to learn the lesson without paying too high a price for the education. This is the purpose of risk management and cutting losses small. It allows you to stay in the game long enough to gain the experience you need to eventually win. The psychology of the speculator is a constant battle against one's own human nature. The desire to be right, the fear of loss, the greed for more, the hope that a bad position will turn around. These are all internal enemies. A trading method, a set of rules, is the weapon you use to fight these internal demons. You cannot be a successful speculator if you are trading on emotion. You must be like a surgeon, cold, detached, and focused only on the procedure. The market will provide you with the patient, the setup, and your rules are the surgical instruments. Your job is to execute flawlessly without letting your hands tremble. This is why he often sought solitude during major market operations. He needed to think clearly, away from the noise, the rumors, and the opinions of the crowd. The hot tip is the most dangerous siren song on Wall Street. It promises easy money, but almost always leads to ruin. He believed that everything a speculator needed to know was contained in the price and volume action. The tape told the whole story. It was the collective expression of all the hope, fear, and knowledge of every participant in the market. To learn to read it correctly was to learn the secret of speculation. The patterns he looked for were not complex mathematical formulas. They were simple visual representations of supply and demand. A long, flat base was a sign of accumulation. A sharp, high-volume breakout was the signal that accumulation was complete and the markup phase was beginning. It was that straightforward. He was not concerned with why a stock was breaking out. The reason, a new product, a great earnings report, a change in management, would often only become public knowledge long after the move had started. The tape knew first. The insiders, the smart money, they left their tracks in the price and volume data. The breakout was the evidence of their activity. To wait for the news is to be late to the party. The speculator's job is to anticipate, not to react. But this anticipation is not a wild guess. It is an anticipation based on the market's own behavior. When you see a stock being quietly accumulated for months, you can anticipate that good news is likely coming. The breakout confirms it. This principle that the action of the stock itself is the primary indicator is the most important lesson one can learn from Livermore. Forget the talking heads on television. Ignore the newspaper headlines. Pay no attention to the broker who calls with a good idea. Watch the market. Listen to the tape. It will tell you everything you need to know. The breakout strategy is the purest form of this philosophy. It demands no prediction. It simply requires you to recognize a specific, observable market event and act on it with a predefined plan for both risk and profit-taking. It is a method for transforming speculation from a gamble into a disciplined business. It is a timeless approach because it is based on the unchanging foundation of market dynamics and human psychology. The technologies will change. The names of the stocks will change. The speed of information will increase. But the patterns of fear and greed will echo through the ages, painting the same pictures on the charts for those who have the wisdom to see them. The initial probe, the test position, was his way of asking the market a question. Is this the time? He would ask with a small initial purchase on a breakout. If the stock immediately moved higher, the market's answer was yes. If it faltered, the answer was no, or at least not yet. This is a far more intelligent approach than committing one's entire position at once. It allows for confirmation. It minimizes the risk on any single idea until it has been validated by the market itself. It is a dialogue with the tape, not a monologue based on one's own unproven opinion. He understood that no man is bigger than the market. Arrogance was the most expensive luxury a speculator could afford. Humility, on the other hand, was a prerequisite for survival. The humility to take a small loss. The humility to admit a mistake. The humility to sit and wait when there is nothing to do. This entire philosophy can be condensed into a single idea. Trade only what you see, not what you think. Your thoughts, your hopes, your analysis. They are all secondary to the reality of the price. The breakout is a visible, undeniable fact. It is a piece of hard evidence in a world of shifting opinions. To build a career on this foundation is to build it on rock, not on sand. It requires the speculator to become a scientist of market action, observing, hypothesizing, testing, and concluding based only on the data presented. It is a difficult path. It requires solitude, study, and an iron will. Most will not have the fortitude for it. They will forever chase the easy answer, the quick profit, and they will consistently find only the quick loss. But for the few who embrace this discipline, who learn to read the story of the tape and to trust its message above all else, the rewards are without limit. This was the core of Jesse Livermore's method, a method forged in fire and loss that ultimately allowed him to conquer the greatest game in the world. The principles forged in the crucible of Livermore's experience are not relics of a bygone era. They are the timeless physics of the market. What has changed is not the game, but the tools with which we can analyze it. Where he had his ledger, his memory, and his intuition honed over decades, the modern speculator has the power of systematic backtesting. To take Livermore's philosophy and translate it into a quantifiable system is to build a bridge from the art of speculation to the science of it. This process does not diminish the genius of his approach. It validates it. It allows us to take his concepts like the pivotal point and examine them under the rigorous, unforgiving light of historical data. A backtest is, in essence, a dress rehearsal for the market. It is a way to live through 1,000 trading days in a matter of minutes, to test a specific set of rules against the past to see if they would have generated a profit. It is the modern equivalent of Livermore's endless post-mortem analyses, performed at a scale and speed he could only have dreamed of. But to test an idea, it must first be transformed from a concept into a concrete rule. Buy a strong stock breaking out of a base is a philosophy. It is not a testable rule. The machine does not understand strong or base. You must define it with absolute precision. This is the first step in moving from discretionary trading to a systematic approach. First, one must formalize the setup. What is a base? It could be defined as a period of, say, 40 trading days where the price has remained within a 15% range. What is a breakout? It could be defined as a close that is at least one tick above the highest price reached during that 40-day period. Next, the evidence must be quantified. What constitutes a surge in volume? A rule might be that the volume on the day of the breakout must be at least 200% of the average daily volume over the past 50 days. Without such a rule, the assessment of volume is subjective and inconsistent. The risk must also be defined in advance. Where is the stop loss placed? A logical rule would be to exit the position if the price closes back below the breakout level, the high of the old trading range. This institutionalizes Livermore's principle of cutting losses quickly when a trade's premise is invalidated. Even the market context can be quantified. A rule could be added that the system will only take long trades if the S&P 500 index is trading above its 200-day moving average. This codifies the wisdom of trading in harmony with the general market trend, ensuring you are swimming with the tide. With these precise rules, for the setup, the entry, the volume, the stop loss, and the market filter, you now have a complete testable trading algorithm. It is a hypothesis about market behavior, ready to be submitted to the historical record for judgment. The backtesting engine will then apply these rules to years or decades of market data. It will identify every single instance where the conditions were met, execute the trade, and apply the stop-loss rule if necessary. It will do this without emotion, without fear, and without hope. It will simply follow the code. The output is not a guarantee of future success, but it is an invaluable piece of intelligence. The first metric it will provide is the win rate. What percentage of the trades were profitable? Amateurs are often obsessed with this number, believing a high win rate is the key to success. This is a dangerous misconception. Far more important is the ratio of the average win to the average loss. A system with a 40% win rate can be phenomenally profitable if the average winning trade is 3 or 4 times larger than the average losing trade. This is the mathematical embodiment of Livermore's core discipline. Cut your losses short and let your winners run. This leads to the most critical metric of all, expectancy. Expectancy tells you what you can expect to make on average per dollar risked on any given trade. It is calculated by multiplying the win rate by the average win and subtracting the loss rate multiplied by the average loss. A positive expectancy is the statistical edge. Achieving this statistical edge is the trader's holy grail, but the process of creating and testing your own system can seem overwhelmingly complex. You don't need to be a programmer or a data scientist to achieve this. In reality, all of this titanic work has already been done for you by a service called Stock Market Guides. It's the very tool we were just alluding to. They've taken a philosophy very similar to Livermore's and translated it into the language of mathematics. The platform scans the market in real time to find the very setups, the very pivotal points, that have historically shown the highest probability of success on specific stocks. You don't just get an idea. You get an idea backed by statistics. The historical win rate, the average return, and other key data. You can use their powerful scanner to find your own setups, or if you're just starting out, you can receive the same real-time trade alerts that the SMG team itself uses. Yes, a quality tool requires an investment, but let's be honest. How much capital is lost to emotional decisions and trading without a statistical edge? This is an opportunity to stop gambling and start approaching the market like a business. Follow the first link in the description to learn more and to start trading with your own statistical edge. The backtest also helps to avoid one of the great cognitive biases in trading, recency bias. A trader might abandon a perfectly good system after 3 or 4 consecutive losses, believing it is broken. The backtest, however, might show that a drawdown of 4 or 5 losses in a row is a perfectly normal and expected occurrence for that system. This historical perspective provides the confidence to stick with the plan. But there are dangers. The most significant is curve fitting or over-optimization. This is the process of tweaking the rules to perfectly fit the historical data. By adjusting the parameters endlessly, one can create a system that looks flawless in the backtest but fails miserably in live trading because it was tailored to the noise of the past, not the true underlying signal. To combat this, robust validation techniques are necessary. One method is out-of-sample testing. You build the system on one set of data, say, from 2010 to 2020, and then test it on unseen data from 2021 to the present. If the system performs well on the data it has never seen before, it is far more likely to be robust. Another powerful technique is the walk-forward analysis, which more closely mimics real-world trading. The system is optimized on a slice of historical data, then traded on the next slice, and the process is repeated over and over. This ensures the system can adapt to changing market conditions. Once a speculator has a system with a proven statistical edge, the next phase begins: execution. And this is where Livermore's rules on position management become paramount, particularly his strategy of pyramiding. Pyramiding is the art of adding to a winning position, and it is the true engine for generating exceptional returns. You do not place your entire bet at once. The initial entry on the breakout is the test. You are risking a small amount of capital to see if your judgment is confirmed by the market. If the trade immediately moves into profit, that is the first signal that you are right. Only then do you consider adding to the position. The rule is to never add to a position that is showing a loss. You only add to a winner. You are reinforcing success, not failure. This is the professional's method. The amateur reinforces failure by averaging down. Livermore's method for pyramiding was specific. If he bought his first lot at $100 on the initial breakout, he would wait for the stock to prove itself, perhaps by moving up to $102 or $103. Then he might add his second lot. He would not add it at a lower price. He would buy it as it was making a new high, confirming the trend. Each new addition should be smaller than the one before it. This keeps the average cost of your total position as low as possible, protecting you from sharp, unexpected reactions. Your largest commitment is made at the lowest price, closest to the original breakout point. Crucially, with each addition, the stop loss for the entire position is moved up. The goal is to quickly get the trade to a point where the initial capital is no longer at risk. You are then trading with the market's money, which dramatically reduces emotional pressure and allows you to sit tight for the large move. This is how a speculator makes a fortune. Not by being right on 100 different stocks, but by being profoundly right on a few and having the courage and the system to press their advantage. One great trade, managed correctly with a pyramid, can fund a speculator's entire year. This disciplined, systematic approach to the markets is a lifelong pursuit of mastery. It requires constant study and an unwavering commitment to your own set of rules. For those who find themselves tested by the market's unforgiving nature, for those who have felt the sting of a painful loss and question their path, this channel is here for you. Subscribe and return to these principles. When the market has humbled you, when your discipline has wavered, come back here to be reminded of the timeless truths that govern this game. Recenter yourself in the logic and the cold, hard evidence that is your only true guide. The psychological challenges of this method cannot be overstated. Even with a system that has a positive expectancy on paper, the human mind can be the point of failure. The fear of buying a stock at a new high is a powerful primal instinct. It feels like you are the last one to the party, the greater fool. A backtest can show you with statistical certainty that buying new highs in a bull market is a profitable strategy. But in the moment of execution, with real money on the line, your emotions will scream that it is wrong. The discipline to override that emotion and trust the system is what separates the consistently profitable trader from the rest. Another trap is the fear of missing out, or FOMO. You see a stock that has already broken out and is running hard. Your system did not give you a signal, perhaps because the volume was too low or the market filter was negative. The temptation to chase it, to abandon your rules and jump in, can be overwhelming. This is a cardinal sin. The purpose of a system is to protect you from your own worst impulses. It is a framework for making rational decisions in an irrational environment. To abandon it in a moment of greed is to throw away your only life raft and dive into the stormy sea. Livermore's greatest triumphs, the trades that made him a legend, were the result of flawlessly executing this entire philosophy. His shorting of the market before the crash of 1907 and, most famously, the crash of 1929, were not lucky guesses. They were masterclasses in following the evidence. He saw the market topping out. The leading stocks of the era, the high flyers, stopped making new highs. They began to churn on heavy volume, a classic sign of distribution. The line of least resistance was no longer up. He saw the pivotal points to the downside as these stocks began to break their support levels. He did not argue with the bull market. He did not get emotional. He simply observed the change in character. He began to probe the short side, taking small positions. When the market broke down and his initial positions showed a profit, he added to them, pyramiding his shorts as the market fell. He was trading in harmony with the new dominant trend, which was now down. While others were panicking, losing fortunes, and clinging to the hope that the bull market would return, Livermore was calm. He was simply executing the same method he always had, but in reverse. His sitting tight with his short positions made him over $100 million. This illustrates the universal applicability of his principles. They are not just for bull markets. They are a way to read the market's intent, whatever that intent may be. A breakout to the upside is a signal to buy. A breakdown to the downside is a signal to sell or go short. The logic is symmetrical and pure. However, it is crucial to end with a word of caution. A backtest is a map, not the territory itself. No matter how robust your testing, there is no guarantee that a system will continue to perform as it has in the past. Market conditions, what are often called regimes, can change. A strategy that worked brilliantly in a high volatility trending market might fail miserably in a quiet, range-bound market. The speculator must be constantly vigilant, monitoring the performance of their system and being aware of the broader market environment. Furthermore, the results of a backtest are theoretical. They do not account for the realities of live trading, such as slippage, commissions, and the psychological pressure of managing a real position. The clean equity curve of a backtest can become a jagged, painful mess when confronted with the friction of the real world. The edge provided by any system is always statistical, never absolute. You are dealing in probabilities, not certainties. There will be losing streaks. There will be drawdowns. The key is to ensure that your risk management is robust enough to survive these periods, so you are still in the game when the probabilities swing back in your favor. Let us conclude with a practical checklist, a synthesis of Livermore's wisdom with the power of modern testing. First, describe your setup. Write down the exact, unambiguous rules for entry, exit, and stop loss. Remove all subjectivity. Second, test these rules on a long period of historical data. Validate the results using out-of-sample or walk-forward methods to ensure robustness. Confirm that the system has a positive expectancy. Third, filter your instruments. Understand where your system works best. Does it perform better on certain stocks, sectors, or market caps? A breakout strategy may work on growth stocks but fail on utility companies. Fourth, implement rules for position sizing and pyramiding. Define your initial risk per trade as a fixed percentage of your capital. Have a clear mechanical plan for how and when you will add to winning positions. Fifth and finally, keep a detailed journal of your trades. This is not just a record of wins and losses. It is a journal of your own performance. Did you follow the rules? If not, why? This closes the loop and begins the process of self-mastery, which is the ultimate goal. This 5-step process is the bridge between Livermore's world and ours. It takes his hard-won, timeless wisdom about market dynamics and human nature, and marries it with a disciplined, systematic framework for testing and execution. It is a path that demands rigor, patience, and an unwavering commitment to the evidence. It removes hope, fear, and ego from the equation, replacing them with statistics and rules. This does not make speculation easy. The psychological challenges remain immense, but it does make it a solvable problem. It transforms the market from a mysterious beast into a complex but understandable system of cause and effect. The final lesson from Livermore is one of personal responsibility. Your success or failure rests entirely on your own shoulders. It is your discipline, your research, and your emotional control that will determine your fate. The market will give you opportunities. The principles of men like Livermore will give you a map. Modern tools like backtesting will allow you to check that map for accuracy. But you, and you alone, must walk the path. And to make that path less about guesswork and more about statistics, remember the tool we discussed. All the principles, from the 5-step checklist to the concept of positive expectancy, are exactly what Stock Market Guides helps you implement. It's the bridge between Livermore's timeless wisdom and modern execution. The link is in the description.